Welcome to the Street's Stocks and Markets podcast, where we dig into what's driving the stock market, its various constituents, and the forces behind them. I'm Chris Versace, Portfolio Manager of the Street's Pro Portfolio, and today, because we're going to be joined by Ed Kovalik, Chairman and CEO of the Prairie Operating Company, ticker symbol PROP, we're going to dig into the oil sector. We'll get Ed's insights on the oil market, other energy markets, and also discuss how Prairie is positioned for what lies ahead. But as we get ready for that, I do want to share with you that recently Roth Capital initiated coverage on PROP shares with a buy rating and a $12 target, calling out what it sees as, quote, an attractive cost structure, improving financial position. In addition to Roth, Citi did something very similar in early June, sharing that it likes the company's, quote, unique position as the only pure-play, single-basin public operator pursuing a roll-up strategy in the Denver-Julesburg Basin. Ed, thanks for joining me.
Hey, thanks for having me on today, Chris. Glad to be here.
So let me ask you a quick question, Ed. You know, there's a lot of different areas in the energy market, so to speak, and obviously Citi and Roth like what they see. But for folks who may not be familiar with the Prairie story, give us kind of, the elevator pitch on the company and its opportunity, will you?
Yeah, happy to. So, we started Prairie 2 years ago, really with a very focused mission to create a pure play, under-levered, high growth, DJ Basin focused mid cap company. And so that was really in response to what we've seen over the last decade, which has been a massive amount of consolidation in our industry. We've had the super majors come down market and buy large caps and mid caps. We've had mid caps consolidating. We've had small caps merging to form mid caps. And as a result of all of that activity on the M&A side, there are far fewer public oil companies than there used to be. And in particular, there are far fewer small cap companies, and there are no growth oriented small cap companies. And so we really wanted to create an investment alternative that looked like that. And as investors, first and foremost, we were looking around the market 2 years ago and couldn't find anything that was compelling to invest our own capital in. And so that really led to the creation of Prairie.
Now, when you say looking around for something to invest in, Ed, this really speaks to your background, 25 years in the energy markets. And correct me if I'm wrong, but you kind of headed up a energy merchant banking firm, correct?
I did. I came out of the investment banking world, really banking, the first generation of shale companies that emerged in the early 2000s, and fell in love with the industry in the process, and went on to work in private equity and merchant banking, investing in mostly upstream E&P across all the basins in the US. It was really at that time that I also really fell in love with the DJ Basin, only because where the rubber meets the road is always economics, and the rock and the DJ always produced superior economics to just about anywhere else in the country. So ultimately that led to, kind of going over the wall to actually found and operate oil and gas companies, and happy to have founded this one with my partner Gary Hanna a couple of years ago.
Okay, so it's kind of fair to say that you've seen the trials, the tribulations, the rewards, if you will, throughout economic cycles and what commodity prices have done. So you're well aware of, the bigger opportunities and mindful of the risks. Fair to say?
Yeah, 100%. I mean, look, in that period of time, shale has been through an entire evolution from, the first days of drilling to today. From a pure operational technological perspective, a lot of innovation has happened in the industry where we're able to drill much better wells than we did 25 years ago. We know a lot more about the reservoir. We know a lot more about producing efficiently and from a low emissions perspective. And in that period of time, we've had to operate as an industry, from moments of very expensive commodity price environments above $100, and moments of very low commodity price environments like we experienced during COVID, where we had
Mhm.
negative oil for a little while there, and then everything in between. So, I think the industry today is an industry that's been through, the ringer and knows how to operate in a very cost effective, cost conscious way.
Well, let's jump into it right there because if you look back, oil prices they've been a little volatile this year, right? As high as 78, $79 a barrel, as low as the high 50s. And with crude, at least today, if I remember the financials correctly, Ed, it's the bulk of Prairie's revenue. So I have to ask, what's kind of your worldview on the energy market, oil in particular, as tensions in the Middle East appear to be settling down?
I can answer that for about 2 hours, so stop me when I've overspoken.
Right,
But commodity prices are the favorite topic of oil companies because we live or die by them.
right.
Um, I guess I'll take you down a little bit of the history road in the past when the industry started. The whole cost structure around shale was designed around $75 long-term prices for oil. And since then, we've suffered through something that we've all become unfortunately familiar with, which is inflation.
Hmm.
And if you look at oil prices today, there's anywhere from about $15 to $20 of inflation built into today's oil prices. So if you look at that $75 historic sort of long-term goal seek price, you know, fair market value for the commodity, I would argue today is really $90 to $95. So here we are in the mid 60s, a good 25, $30 below that price. I'd say oil is very cheap today. Now, why is it cheap? I have no idea. And I say that in full seriousness because the commodity hasn't seemed to respond in any logical way for a number of years coming out of COVID. The one thing that I'll note that's absolutely true is that demand for fossil fuels goes up every year. And
Hmm.
we've seen that really, since the advent of and the discovery of fossil fuels, you've seen a straight line up and to the right. There have only been really two occasions where that line of demand growth has been disrupted. One was '07, '08 during the credit crisis, and then most recently during COVID, we saw that. But representative of the true elasticity of demand, those short hiccups in demand were very quickly solved for, and then you saw the demand curve continue up and to the right. And so, in that context, demand, even though there's been a lot of talk about cooling economies, a lot
Hmm.
of people looking at China or the developing world in general, China and India, or looking at the supply side of the equation with OPEC. We've never really seen economic downturn affect demand in a really material way, aside from those two occasions that I noted. And so there's been a lot of speculation and a lot of talk around what's really happening in the oil markets. If you turn your attention to the supply side and OPEC, what I always look at is true global storage. And that used to be a metric that used to drive prices, and people would look at Cushing and talk about the tank bottoms. They'd look at the floating storage of oil around the world on vessels. And by any measure, storage as a correlative to oil prices kind of broke significance because we've been at points of hitting tank bottoms, and yet oil price never really responded and reacted in any material way. And then on the flip side, we've had geopolitics in and out of the conversation. Pre what we witnessed a couple of weeks ago on Iran, Israel, and the U.S. And all the conflict that we saw there. There's a lot of talk about what could happen if war broke out in the Middle East and different scenarios. And there used to be just a geopolitical risk premium built in. But we went all the way up to the precipice of war. I mean, the US bombed Iran, and we
Hmm.
saw
Hmm.
no reaction in commodity prices. So I think we're living in a world today where, it's a very unpredictable commodity to price on a go-forward basis.
So, when you say that, and then we look forward a little bit, where I think OPEC Plus is supposed to, in August, increase their production. I think it's 411,000 barrels per day. Do you think the market's going to react to that, Ed, or do you think it's just going to, just like you said, with the bombing in Iran and oil prices, there might be a blip a little bit, but ultimately things will settle back down.
It's hard to tell because OPEC's clearly been increasing output the last several months. However, they've been unable to actually produce to the quotas that they announced, which is a topic that I don't think a lot of your viewers may be privy to. But there's rampant speculation about how much actual production capacity a lot of the OPEC countries have. In particular, Saudi Arabia, which has never made public really the ability of their ability to ramp up reserves, and so it's a closely held state secret whether or not they really can. Now, Russia produced a little bit more pre, uh, uh, I guess, pre the Ukraine war and some of the disruption that they've had as a result. Can they increase production a little bit? Maybe. I'm pretty bearish on their ability to ramp quickly. Kazakhstan's been overproducing, and so there's some argument around the fact that OPEC has been trying to ramp up production to uh, force compliance of non-compliant states like Kazakhstan. But a lot of focus has been on U.S. shale, and is U.S. shale going to react as sort of the pressure release valve on supply? And so I'll remind everybody that in the U.S. We're mostly producing from shale oil, and we produce a little bit over 13 million barrels a day. And really, shale is a game of just maintaining production because there's such fast decline on new wells. And so I think it'd be really hard for us to grow production in this country. I think it'd be really easy to see a decline in production if we saw prices settle below $60 for some prolonged period of time. We've already seen, some rigs getting mothballed in the U.S. I think you probably see up to a third of all U.S. rigs being laid up. If you saw mid 50s to $50 pricing for a quarter, so the U.S. may very well be the pressure release valve, but it may never come to that if prices don't come to that, and then we'll really test whether or not OPEC is trying to force compliance or OPEC is really trying to start a price war with the U.S.
So Ed, it sounds like there's a little bit of push pull, right, between uh, how much capacity is on the market, subject to what the price of oil is, and I think that it really speaks to the industry's cost structure. And I mentioned a few minutes ago that in the report that Roth wrote about Prairie, it mentioned the company as having an attractive cost structure. And I know it seems like an obvious question, but for the listeners out there, why is that so important? And how is Prairie able to have such well, as Roth would say, an attractive cost structure?
So at the end of the day, our business is really a manufacturing business, and by all measure, U.S. shale is the U.S.'s largest manufacturing industry. And instead of manufacturing widgets, we manufacture molecules of oil. And so, like any manufacturing business, it's all about costs. We measure costs in a number of ways, uh, starting with what it costs to produce oil vis-a-vis a well. We've worked really hard at Prairie to lower our cost per 2 mile well down as low as we can get it. Right now, we're hovering a little bit above $5 million for a 2 mile lateral well. And the way we got there, which is really a great accomplishment that we're exceptionally proud of, because our peers and offsetting operators are currently drilling the same wells for 6.5 to $7.2 million. And
Mm.
so the way we did that is essentially by stepping in as and acting as the contractor and not using any middlemen. So we contract our own sand directly from a sand mine. We manage the logistics to transload that onto rail cars and move them to location, transload them from rail to where we're fracking. We do the same thing for all the chemicals we use. We source all of our steel casing direct from a U.S. mill, so we're not, having to pay any kind of tariff penalties for foreign steel. And so, in every line item that we spend money in, we go direct to the source and we manage all of those processes ourselves. And so that's driven that cost down significantly. The other cost is our lease operating expense and transportation to get our oil to market. That number is also really low compared to many other basins for a couple different reasons. One is, we don't produce as much water as the Permian, for example, when we produce our oil wells. And that just has to do with the geology of where we're at. And so every shale company, no matter where they are, produces some level of water out of the formation, and that water costs money to lift, above ground, to separate from hydrocarbons, and then to dispose of back down a saltwater disposal well. And so the more water you produce, the more expensive it is. And so that water cut for us being very low compared to other basins lowers that cost significantly. On the transportation side, in terms of processing the gas we make and moving our oil into oil pipelines, we are hooked up on most of our operations into pipe. So we're really not paying for excessive trucking expenses as a result of that. And we also happen to produce an oil that is a gravity of 38 to 42 API spec, which is more valuable than a lot of the other oil produced around the country. And so we're able to get a premium for that oil of about $1.50 per barrel by getting it into the right pipeline that's able to transport it to Cushing to capture that spread. And so that piece of our cost structure is really competitive. Moving on to our G&A, we're currently operating the company for a little over $2 per barrel in G&A, which is half of what our peer group currently operates at. And so in all those ways, we're able to really shave cost out of the equation. We're not done yet. We're still working to lower those costs, but that's a really important piece of our business.
So I know a lot of folks talk about, break even based on, a dollar price for a barrel of oil. Have you guys shared what that is? If so, what is it? Where do you think you could get it to?
Yeah, so our assets have variable levels of IRR, and as a result of that, our break-even range is somewhere in the high 30s per barrel to the mid 40s per barrel. And so, we could say it's around $40 or so per barrel. So we make a decent margin at, $65 oil. Um, I'd say that at the end of the day, um, break evens for the industry on average probably hover in the mid 40s, is my guess. And so at $55, can we make money? Yes, but is anybody excited about burning through inventory, which is, a diminishing resource at
Mm-hmm.
$55 oil? Probably not.
Okay. Okay. So in looking through, your materials, your presentations, you've got about 550 identified locations, 157 are fully permitted. But I've also seen, Ed, that, part of the strategy for Prairie is to do acquisitions. And I hear what you're saying about wringing costs out of your business. Is that a bigger opportunity to pick up, let's just say, production facilities that might have been mothballed or they're just not as efficient? Is that a strategy that you guys can wring costs out and get a lot of incremental profit at a lower starting cost, I guess?
So M&A is absolutely a pillar of our strategy. We are trying to generate high growth really through two means, through M&A and through pretty aggressive development through the drill bit. And so on the M&A side, we just announced another deal this morning. We acquired the assets of Edge Energy for $12.5 million. that added 40 proven locations to our portfolio that are immediately offsetting our existing assets. And we've got a pipeline of probably $3 to $5 billion of deals to go do. This is the third deal we've done in the last 12 months, and the smallest one. We did a 80 million-ish dollar acquisition last October. We closed the Bayswater acquisition for a little over 600 million in March, and so we are very acquisitive as long as we can do accretive deals. And the way we look at these deals is, we love proven locations. We love reserves that we can acquire for a competitive value. We love this basin because we can acquire both of those things at really deep discounts compared to the Permian. And that's part of our core strategy is, to be contrarian and to focus in a place where nobody else is focusing. So where we're focusing, we're able to buy proven reserves for about a average PV 17 valuation, as compared to the Permian where they're buying that at a PV 10. So we're getting a much better return on proven reserves.
Ed, just let me cut you off.
Mhm.
Can you just explain that metric for the audience?
Sure. So it's the present value, PV is present value of the existing producing cash flow. So we just take the cash flow, we discount it back on a time value,
Hmm.
and we calculate the return. So essentially, we're buying cash flows at an embedded 17% rate of return, as compared to the Permian, where competitors of ours are buying cash flows for an embedded 10% rate of return.
Okay.
And then in terms of inventory of proven locations to develop, we're paying anywhere from $100,000 to $225,000 for an undrilled proven location to drill. In the Permian, they're paying $3 to $7 million for a proven undrilled location. And so in our business, we like to talk about half cycle returns and full cycle returns, not to confuse your viewers. But
Hmm.
half cycle returns are the returns you generate from drilling a well. And so in that case, we look at the cost of drilling a well of $5.2 million or so for a 2 mile well. And you look at the IRRs, and, we're able to produce wells for 30% IRRs in the low end to over 100% on the high end, depending on our portfolio.
Hmm.
And on a full cycle return basis, that includes the cost of acquiring the wells. And so, because we're basically buying cash flow at a steep discount and we're paying virtually nothing for proven locations to drill, our full cycle returns look very similar to our half cycle returns.
Got it. Okay. And I saw that you guys recently reaffirmed, I think it's $1 billion lending facility with Citi, if I read correctly. That sounds like, on the one hand, I want to say compared to the acquisition you most recently announced, that could be a lot of deals. But you also mentioned one, I think it was the Bayswater one. You said it was 600 million, correct? So how should folks think about the size of these acquisitions that you might make? And as they're thinking about that, acquisitions can be messy sometimes. Sometimes they can be smooth. How many acquisitions can the team handle at any given time?
Well, let me start there. So, for one, everything we've been acquiring is immediately in our backyard and contiguous with our existing operations. So, it's very easy to integrate these operations, and they all feed into our midstream takeaway and gathering systems. So, we are not diluting the attention and focus of our team to have to go somewhere else. We're not having to incur more G&A to build, mirror teams in other locations. And so we're very myopically focused in one zip code, which helps that strategy. In terms of size of deals, you saw us do a little one today that was 12 and a
Mhm.
half million. You've seen us do one over 600 million. That's probably a good range. I know it's a wide range,
Right.
but that's the range we see deals in. Establishing the credit facility with Citi was really important because, as far as cost of capital is concerned, the credit facility with the banks is always the lowest cost of capital in terms of credit. we're focused on really maintaining an under-levered balance sheet, which is about 1 to 1.2 turns of leverage, which is kind of where we sit today. And having a group of great banks and a credit facility is really a privilege because we can scale that credit facility up to accommodate bigger deals should we want to go do them. We can leverage on uh, those institutional partners for all of the hedging that we do. And so recently we also brought Bank of America into that credit facility. So we've got a great group of partners in that credit facility.
Awesome, awesome. So as you look forward, do you see, if you had to break down the revenue growth, how much of it do you think will be organic? How much of it do you think will be from acquisition?
Well, it's hard to predict the acquisition piece of it. And taking today's deal into consideration, for example, we didn't really buy it for the revenue. We bought it for the inventory to add on those 40 locations. Without taking into consideration any more M&A, we can grow at a double-digit rate year to year, which is our goal. We haven't really guided more specifically how aggressively we're going to grow, but we're currently running a one rig program with a one frac fleet that kind of mirrors that. And so, what does that mean? Well, in the DJ Basin, we're able to drill 2 mile wells in a little over 4 days, which is wildly efficient if you think about
Mhm,
that.
mhm.
And so with one rig, we can easily drill about 60 wells a year, possibly pushing into the 70 well plus per year with 100% efficiency. And so 60 wells a year, we can develop our inventory over the next 10 years. And so that's kind of how we like to manage the cadence of growth is really to that inventory life. So with 10 years of inventory, why would we design the company around that? Well, being a student of our industry and of the markets for our peers, our takeaway in starting the company was that the market doesn't really ascribe value to long dated inventory that companies like us have that goes beyond 10 years. It's kind of worthless. So essentially, 10 years is a bit of a magic number. Now, let's say we get into, let's say we roll forward 2 years from now as an example, and now we have 8 years of inventory, and we buy something that gives us another, 500 locations. At that point, I think we'd sort of redesign the the cadence of drilling so that we go back to having 10 years of inventory, but we probably employ more than one rig and we drill more than 60 wells per year to sort of, you know, uh, meet that 10-year inventory kind of projection, right? So if we have 800 wells in inventory, for example, we'd want to drill 80 wells per year as an example.
Right. And just to call it out, Ed, it's not a fixed 10-year. You're talking a rolling 10-year.
Well, it's a fixed 10-year unless we buy more inventory.
Okay.
So
Okay.
essentially, we're blowing down our inventory over 10 years is the way to think about it. And every time we add inventory through M&A or through organic leasing, which is an important thing to note. So, we've got a really good land team that's in there leasing additional locations day in and day out, and then creating drillable units out of that activity. And that activity in and of itself will probably add a couple years of inventory life to our
Mhm.
portfolio over the next couple years. So without doing any M&A as we roll forward for the next 2 years, we'll probably maintain about a 10-year inventory life.
Okay. So if we kind of game this out a little bit, as you just said, over the next few years, let's call it, I don't know, 3 to 5 years, something like that. How do you think Prairie's going to look then compared to what it looks like today?
Well, the next big pivot for us as a company is to return cash to investors. And, as big equity investors ourselves, we're keenly focused on that strategy. So essentially, the way to think about us is, you know, we're reinvesting this year
Hmm.
100% of the cash flow we generate back into drilling so that we can accelerate our growth trajectory. But by maintaining our CapEx flatly every year for the next 10 years, based on what I just described, which is
Hmm.
maintaining a one rig program for that 10 years, we start to exceed the amount of cash flow we need for our CapEx program
I think
next
I know.
year.
I think I know where you're going, Ed. I think the magic word is dividends.
Dividends, right? And so we ought to be in a position next year where we're exceeding cash flow compared to CapEx, and we're able to distribute cash as a result. And so that's really the next big move for us. And look, there's still a lot of M&A to do around us. We've done 3 deals within the last 12 months. We're going to continue executing on that. We've got a great pipeline of actionable transactions to do. We just don't want to do it in a way that's dilutive. And our stock price today is exceedingly low, where we're
Hmm.
not going to use that currency right now to acquire anything. To know, we bought the Edge assets with cash on hand from our credit facility. It was non-dilutive. We love those types of deals. If we get our stock to a level that we think is fair market value, then we'll be open to using it again as currency. But you're going to see us accomplish that task, and you're going to see us continue to roll up assets around us.
Excellent, excellent. Final question. We've talked a little bit about, the oil market, the opportunities with Prairie, but for someone who's new to the story, Ed, what are the one or two risks that you and the rest of the management team kind of, continue to focus in on, or folks, I guess we could say, should be mindful of?
Well, I mean, the big elephant in the room is commodity price risk. And, you can't be an oil company without assuming that risk.
Right.
Um, we hedge for that. So, we're certainly not believers in the idea that people ought to buy Prairie stock as a way to expose themselves to oil prices. You can do that yourself without us. You can go buy WTI and trade that. And so what we do is we try to eliminate that risk to the best of our ability. When we purchased the Bayswater assets, for example, we hedged 85% of that production on a 3-year roll forward basis. I think we locked in our oil price hedges at $68 and change, and our gas hedges above $4. And so we're big believers in taking that risk off as we drill wells, uh, which we're doing every day. We'll continue to hedge as we bring those new wells on production. And so that's the biggest risk. The other risk that our industry has experienced has been leverage, and
Hmm.
companies have gotten over their skis in terms of the amount of leverage that they have. It's part of our core mantra as a company to remain under levered relative to peers. Some judicious level of debt is healthy to operate with, and we think we've got the right structure for our credit, which is, the bank line that I described is the lowest cost of debt out there in the market. And we're, purposefully maintaining that at a low ratio compared to peers. And then in terms of just operational risk, we work in a mechanical business, and so there's always a risk that you drill bad wells, or you drill wells that don't produce oil because you did a really bad job. And so we manage that risk probably best of all the other risks because we drill proven reserves. We've got a really great team that I'm exceptionally proud, to call my team of industry veterans that have come from, pedigree, great companies. We've recruited people from Chevron around us, and Oxy and other great companies that operate in the DJ Basin. So we've got local know-how. We've got national experience of drilling in all sorts of basins, all sorts of rock. And we're also blessed because where we drill in the DJ Basin, has the most consistent results of drilling as compared to any other basin, including the Permian. And
Mhm.
so, we're kind of statistically favored to do well, but we like to ensure we do well, by having the best possible people on board on the execution side. So, I think we manage all those risks pretty well.
Excellent, excellent. Ed, you've been so generous with your time. Was there anything about Prairie or the industry that we didn't talk about that we should before we get out of here today?
The only other thing I get asked a lot about, which, is a funny topic, is sort of renewables and the energy transition and,
Okay.
how long are we going to need energy from oil and gas and fossil fuels for? And it's a sobering conversation when I illuminate all the statistics for people, because at the end of the day, oil is not an obsolescent asset. As long as we live and breathe, hopefully for decades to come,
Mhm.
we're going to see demand for fossil fuels increase every year as it has, because fossil fuels is a energy dense form of energy. The only competitive form of energy is nuclear, and nuclear is going to take decades to work itself out of the regulatory quagmire that it's in, and get built prolific in a way that's prolific to really meet the demand of AI data centers and everything we're
Right.
seeing there. But low energy dense forms of generation like solar and wind are not going to take over the industry. And I always remind people that everything in their daily life is made in some way, shape, or form with a petroleum based product. So, you know,
Yes.
the computers that we're using right now to talk to one another with, the makeup that our wives wear, the surfboard, my kids use at the beach, uh, they're fossil fuels in everything. Fossil fuels, everything.
Yeah.
So,
I think the only thing I've ever seen that's as prolific is corn.
yes,
And that's
that's right.
if you for folks listening, if you know what I'm talking about, that should tell you how important and how many uses there are for oil, petroleum, call it what you will. Well, Ed, thank you so much for joining us. I know that between acquisitions that are likely to happen, the eventual dividend stream, there's going to be a lot to pay attention to on the Prairie story. And I'm going to ask that at some point, maybe later this year, early 2026, we can have you back.
Hey, it's always a pleasure. I'd love to come back anytime, Chris.
Awesome. All right. Thank you, Ed. Folks, be sure to take a look at Prairie Operating Company, ticker symbol PROP. Look at the investor relations stuff, look at their SEC filings, and I'm sure that Ed and his team would be happy to chat with you if you have any further questions or interest. And as far as the Streets Stocks and Markets podcast, that's our episode for today. Thanks for tuning in. We'll be back with you with a fresh episode before you know it. All right. What do you think, Ed?
Felt good to me.
Excellent.